right. Thanks so much, Pablo, for the great intro. We have amazing speakers here. I'm like Pablo introduced. I'm Camila Russo, founder of the Defiant, author of the Infinite Machine. We have Carlos from Securitize, Sebas from Ripio. Let's get to it. I think the most interesting trend recently in crypto has been this intersection of institutions, TradFi, fintech, with crypto, DeFi, and you two have a really great seat at kind of the forefront of this happening. So let's start by talking about what enabled this intersection, which really accelerated in the past 12 months. Carlos.
I think that, first institutions, all the transactions and everything they do runs on ledgers, right? So every single transaction when you buy a stock in the open market, in the public markets, or when you transact on a private company, or when you buy a bond or a money market fund, a mutual fund, whatever involves, updating a ledger that records the ownership of the asset. And then if you do anything with the asset, you sell it or you trade it with somebody else or you pay a dividend or you redeem some units of the fund, involves updating sometimes multiple ledgers, right? So, the securities ledger, then the cash ledger, sometimes, 3 or 4 different ledgers that are siloed, they're not connected to each other. And a blockchain at the end of the day is just a better public ledger that allows everybody to trust the content of the ledger and track the ownership, right? That's the original idea of the Bitcoin, was that it's a ledger where the double spend problem is solved, right? And updating ledgers to make sure there's nothing double counted is the #1 problem in how financial markets run. And this is why a lot of intermediaries exist, a lot of inefficiencies, a lot of long settlement times, counterparty risk, while these ledgers are being updated, etc. So a blockchain is just a better ledger to do that. Now, institutions, I think somehow they've known that this is a better ledger, but they haven't actually participated in the market. I think for a variety of reasons. One is obviously, the industry was very, you guys have been around as long as I've been. It was very, in the early days, it was a pretty crazy space with, the technology was very hard to use. There was a lot of ICOs and things that, with unclear, let's put it that way, regulatory clarity, etc. And then, so institutions didn't participate at all in kind of the first wave in 2017, 2018. Then you got the second wave in 2021 with DeFi summer and all these things that happened. And I think at that point in time, institutions at least were starting to look at the space, and they all had, kind of hired people that had the knowledge, etc. But after, I will say 2020 to 2023 is when really I saw institutions really coming to the space and really taking an interest. I think the industry had matured, stablecoins were already a reality, crypto was already multi-trillion-dollar asset class, etc. So I will say for us, 2022, first with KKR, and then 2023, 2024 with BlackRock was when we really saw institutions coming and saying, yes, we want to actually now try to put our products in this ledger, right? And I think now, especially in the US after the change in the administration and the kind of started of regulatory clarity that we started getting in some parts of the industries, when I really see institutions coming in mass into the space, but it's still very, very early days.
I agree with all that. I think another thing is that it also needed to get old. So I think we're having a lot more traction and recognition by institutions and but broader population, just by the fact that it's been running for more than a decade. And I think one of the things that needed to happen is it needed to prove itself. The technology, I think, when you hear people attacking the industry or tokenization, you rarely hear people saying that the ledger is worse. You don't hear that. There is a recognition that the technology is better, so they attack it from other ways. JP Morgan will say it's for criminals, and it is, or they rarely criticize the technology. And I think by being successful, being running for so long, with such a high uptimes, has been breaking all the narratives, including people that was like very against it, like JP Morgan that had to switch their narrative recently.
Actually, you know, from the banks in the US, JP Morgan is the one that has had the largest blockchain team since the very beginning.
Yeah.
They were against Bitcoin, but
Yeah.
they were pro the technology, so which
Yeah.
are kind of two different things.
They did block the entire industry from having bank accounts and touching them. But
True. So crypto and blockchain, two different things for them.
for them. But anyway, so I do think that is one key key aspect that it needed to get proof itself, and now like I think like people is starting to realize that this is not gonna go away, and with changes in like also in the power structure, like the industry became a lot more powerful. We also got able to lobby a lot more and with more power and regulators and like and make and have our voice heard. And this is something that is changing across the world. Particularly here in Argentina, we now have a framework to issue securities on a distributed ledger. We were the first ones to tokenize a bond, and that was like this was weeks ago. The framework has month and a half, and it's been I think it is an amazing experience, but it also shows the power of it. We had really good timing into tokenizing the most traded bond in Argentina, which is called AL30. We tokenized it as WL30, and this was the first bond that was traded on a Sunday on an election day, and that we even ourselves got like surprised about the amount, the volume that it had for being an asset that has just a few days, and how many market participants also integrated. Because we also have Argentinian brokers that wanted to integrate for that, and they did it in record times to be able to be trading on that Sunday, and to give to give an idea, on that day was traded more than 1 million bonds, which in a normal day it trades 10 million. So it was a large amount of trading for an asset, for a representation of an asset that that is very new, but also provided something that the market really wanted, which is on a Sunday, on an election day, there is a lot of information coming, which is like it changed the structure of the political landscape, and that will have a big impact on Monday, but you will be able to get that information on a Sunday.
Absolutely.
And
Yeah.
it's just a glimpse of future.
So yeah, I agree. I think what really accelerated institutional adoption in crypto regulation was a huge part of it. Yeah, you saw it in Argentina. Obviously, in the U.S., it was a big shift in regulatory clarity. And yeah, I think that it's a great point to make that the longevity, just proving itself, goes a long way with institutions. So okay, we talked about what changed for us to get here. In the current environment, what would you say is working at the moment in tokenization? Like, which have been the use cases to really take off? Where is demand coming from? It seems like institutions are looking to tokenize their assets, but they're not on the demand side. They're not buying these assets. So if you can talk about kind of the different sides of demand in the market and what use cases are taking off.
Sure, I can take that. In the early days of tokenization, there was this kind of misperception that if you tokenize an asset, you magically make it liquid. So there was a lot of projects of tokenizing illiquid assets, ourselves guilty, having done some of those projects and realized that, tokenization actually makes it easier to trade it. It makes it easier to settle the trade. It makes it easier to do 24/7 on a Sunday, like Sebas was saying. But if the asset is illiquid, it's illiquid, and just it doesn't magically become liquid. So I think that, we've kind of pivoted to the opposite side. Let's take, and I'm assuming this bond is very liquid, right? The ones you guys tokenize. So we've gone in the opposite direction and say, okay, let's take the most liquid assets and then bring them on a better ledger to make them even more useful, right? And I think that the most successful use case of tokenization is the dollar, actually, right? Because the stable coins are tokenized dollars, and then they are the largest asset class by a mile because they're like 300 billion. And that has been extremely useful in terms of making sure dollars move better than on traditional rates, but dollars are already liquid, right? It's just they make it more accessible, easier to trade, easier to move around, etc. And then if you look at the second largest category, which is a lot smaller, is actually treasuries, which is adjacent to dollars. It's also, at the end of the day, it's a claim against the same entity, which is the US government. It's a very, very liquid asset. It's almost as liquid as normal dollars, or the same. And tokenized treasuries is the largest second asset class that has been successfully tokenized. We have the product that we tokenize with BlackRock, which has around 25-30% market share. But there is like 44 different companies tokenizing treasuries out there since the last 18 months. So I think that we're going to see bonds are a good example, as Sebas was saying. Like, instead of going and trying to tokenize illiquid assets, that will come at some point when you have a lot more demands, etc. Then you start tokenizing the most liquid assets to just make them even more, accessible, useful, trading in offsite market hours, settlement more efficiently, eliminate counterparty risk, intermediaries, etc. So I think that from an asset class perspective, we're kind of focusing there. And from a demand perspective, people that want to tokenize things, there is no shortage of it. In fact, it's actually the opposite. Like, we get a ton of like random requests for tokenized things that make no sense. So yesterday, actually, I was giving a talk to my team here in Buenos Aires and telling them about these things that we say no to like 95% or 98% of the things I get. And that just that day, we got a demand of somebody that has a brunch restaurant in Miami that makes $2 million in revenue that he wants to tokenize it. It's like, that makes no sense. You shouldn't tokenize that. You're not solving any problem. Nobody's going to give you money because you tokenize it. You're not going to make your little restaurant in Miami liquid just because you tokenize it, etc. So, but the supply, is there for sure, both in these random things, but as well on the large financial institutions. We talk to all the large asset managers in the world. Some of them are already customers like BlackRock, KKR, Apollo. We recently started a project with BNY, which is the largest custodian bank in the world, etc. And I can tell you every single asset manager and bank is looking at a tokenization project today. Whether they're going to do it or when, these are like large like enterprise type sales that take a very long time, but they all are going to do something. The demand, though, is what's still partly there. It's mainly coming from crypto people. So I don't think institutions or non-crypto institutions have adopted tokenized assets, and I think we're still probably 2 to 3 years away from that happening because there's still too much friction to use, tokenized assets. You have to create wallets, you have to deal with, private keys, you have to use stablecoins if you want to manifest some of the advantages of, trading more efficiently or redeeming on 24/7. If you want to leverage the asset, then you have to go to a DeFi protocol, and all those things have friction today for a non-crypto institution or a non-crypto user. This is going to be eliminated over time, but it's still not there. So,
yeah, I was going to comment the thing that you were saying, like the first real world asset is the crypto dollars, the stable coins of US dollars. And I think that, well, we believe as we are tokenizing bonds, we are also tokenizing local currencies now as part of our B2B projects. And I think that is part of what is the next wave of tokenization. I still think we have a lot to do and big way to, a lot of things to improve with the current assets. One of the frictions of stablecoins is that they're very efficient for doing small trades. So like we beat every system in the market for making millions of small FX trades with the stablecoins across the globe. But if you want to do a large stablecoin transaction on millions of dollars, then you have like the traditional system beats you, and it has much. It has it's kind of like opposite to crypto. Like the larger the trade, the most efficient it becomes the traditional finance compared to crypto, and I think that is a friction into going into some use cases that need to be solved with the stablecoins for like a large asset manager to use a tokenized asset and buy a few million of anything. If there is an impact on FX, why I will do it if I just go and can do it through the traditional rails and be cheaper, while not faster or maybe not reliable. But that is one of the things that I think we do need to improve in the current infrastructure. But I think like everything will be tried to be tokenized, as Carlos said. Like there is a huge demand of people coming to wanting to tokenize things. A friend recently asked me if he could tokenize a horse, which definitely was not gonna have demand. But anyway, he keep insisting. But that like eventually everything is gonna be tried to be tokenized. Maybe the systems become more advanced, that we can give pricing, real-time pricing to anything. But there is a lot to do already with the current assets that exist that are liquid, that can have a much better market with this technology.
Also keep in mind, stable coins are not legal yet, right? Like the Genius Act just passed, but there's still like a moratorium of 18 months, I can't remember exactly, until all the current providers really adapt to the new legislation and are compliant with it, right? So institutions, on the other hand, issuing securities has a very good regulatory clarity. One of the things the SEC did in the US after Paul Atkins took over as chairman and they created the crypto task force is they basically issue a statement as a result of a letter we sent to them, basically saying if you're a regulated entity like we are and you want to represent securities on a public blockchain, it's okay. Just use that. You have to still comply with the rest of regulations, investor protection, disclosures, all that stuff. But the ledger technology, this ledger technology is as good as any other one. So it's easier for institutions to issue securities than to use stable coins today, because stable coins are not like legal yet. But the problem is when you issue securities on a blockchain, but you don't issue dollars, then you're only manifesting part of the advantages, right? Because the main advantage is that the same ledger with the same underlying technology, the same kind of entry of a database, which is the token, represents both dollars and securities, and then you can just trade against each other in a more efficient way. So still for of course, crypto people don't care. They use stable coins. I mean, the largest stable coin is a stable coin that, for many years there was questions about, the regulatory situation, and people didn't care, right? But like large institutions, like the ones we work with, they will not take stable coins as a deposit for their funds at all. They'll want all the time to be converted to dollars first. So we still are years away from penetrating the TradFi market, but look, it's not a problem because today crypto is $4 trillion, right? Or, well, I don't know, maybe 3 today, because the market has crashed recently. But it's large enough that a portion of those assets will ultimately become real world assets, which is a terrible name, but because in TradFi actually RWAs means something else, but it signifies that those assets will not be kind of volatile, not backed by anything assets, but will be like backed by something else. And if you only need like 10% of crypto, let's say if it's 4 trillion, to move to real world assets, to move the industry from like 20 billion today to 400 billion. So there's still a lot of growth within the crypto industry, not to worry about TradFi, as far as you have the supply of the TradFi assets into the crypto industry.
Okay, so the state of the art right now in RWAs and tokenization is institutions are providing the assets. They're tokenizing real-world assets, stablecoins, and so on. But the demand is coming from the crypto world. You talked about regulation as being kind of a big barrier for institutions to be on the demand side as well. What else needs to happen to, bring institutions into crypto in a more, like meaningful way?
Improving the user experience, maybe, because it's a complete disaster today.
Yeah.
I don't know. Yesterday, Aave actually released an app. I haven't tried yet, but I was talking to Stani and Seb a few weeks ago about this. I think that's a good move, right? Because for a non-crypto native person, the user experience of crypto is a bit of a disaster. So too many blockchains, yeah, even the wallet providers, even though they've improved since I started in the industry in 2016, but it's still very complicated. You have to, there's no good switching across blockchains and moving assets here from there, and it's just like not a very good user experience. You need to simplify this for mass market to adopt it. So I think improving the user experience and kind of hiding the complexity of the blockchain and the tokens behind the scenes, so you don't actually even notice that you have a tokenized asset. You just have an asset. I think that's the big other gap that you see there in terms of adoption.
I'm hopeful that we will get there in user experience. There are a few, well, you see more and more like apps that are starting to find ways to reduce the complexity and no need to show the user what is the underlying technology. I think Polymarket, for example, is doing a great job in that. Like I think most users of Polymarket don't know that it runs on Polygon.
Well, I don't know.
Yeah,
I disagree a bit with that.
well, but
You have to have assets in Polygon to be able to pay for the transaction, and then you have to bridge them from another chain if you don't have in Polygon.
no, but the RAMs they have obscured that, and they also lately it's like the user doesn't sign transactions, and I think they have
Maybe they improve. Yeah.
they from the first version to today. I think it also is what has made them so successful. And then we will see more like I only seen screenshots of the Aave app, but it also looks like in that direction of like not showing what the blockchain is and choosing the underlying blockchain for the user, doing RAMs that have like zero fees and that go one-to-one with the assets that are being deposited, and I think that all things that we're going in the right direction, very slow pace, but I'm hopeful that we will get there.
And to wrap up, if you could each talk about the developments that you're most excited about at your own respective companies, at Carlos at Securitize and Sebas at Ripio.
In our case, as I mentioned at the beginning, we kind of like over the years moved from looking at illiquid assets to the most liquid assets. So if you think what's the most liquid asset in the world, besides let's say dollars and treasuries, are public equities. So Tesla shares or Apple shares are probably the most liquid asset out there. So tokenization of public equities, which is Sebas and I we've discussed. There's a lot of people doing a lot of like kind of weird stuff that I particularly don't like because they create derivatives or price trackers, and that's not the real thing, and it introduces all sort of systemic risk, counterparty risk, probably regulatory risks, etc. But there is ways to do it in the right way, where the token does actually represent the real share of the company. So you buy a token is like you buying a share on Robinhood or on some other trading app, and I think that has a lot of potential for two reasons. One is because first, most people, I mean, you guys are not in the US here, but if you're in the US, people, I can just go to Robinhood and buy an Apple share. Sure, but if you're somewhere else, it's not that simple. So in terms of, global distribution for one of the most demanded assets, which are, US public equities, has a lot of potential if you move them to tokenized format and blockchain rails, etc. And then it also solves some of the problems of, actually really owning the shares, being able to place them, to borrow against them, to being able to trade them on the weekends in an efficient way, like Sebas was saying with the bonds, etc. So, and bonds are also adjacent, right? Because bonds are liquid; they're not as liquid as equities, but they're also liquid assets. So I think that category, which hasn't been cracked down yet, and is potentially huge. Like if you were to move 2% of all the U.S. public equities on chain, it will double the size of the crypto market. 2%. So only a very small amount of that moving on chain really makes crypto markets way bigger. So, and I'm very, very excited about it because we've started to see for the first time, companies, large companies that you will not think of coming and saying, oh, we want to explore this and we want to figure out how to do it in the right way.
Yeah, important to do it, like you say, in a way that where the token actually represents a share of the company and it's not like a derivative of the stock.
Correct, because derivatives first, besides introducing counterparty risk that people are not aware of it, they also create fragmentation. Because then, you're going to have 20 different versions of Tesla. It makes no sense. It makes no sense to me. I get what people do it because people are just, being opportunistic. And in crypto, you always have grifters that are trying to figure out how to make money without caring about the consequences of it. But for the industry, it's a terrible thing. Because if that starts happening, it's just going to make everybody scared about that, and that's not going to take off. So hopefully, crypto people will be rational once in their lives and try to push for the right thing to do.
On our side, over the last few years, we have been focusing on building infrastructure and APIs and tech to help banks, fintechs, and e-commerce to integrate crypto. We have really great partners, and some of the largest fintechs and banks in the region are using our infrastructure to provide crypto to their clients. And over the last year, we started to, we realized that we could do kind of like use all that infrastructure that we built over the last decade to also help crypto companies to have that connection to the rest of the financial infrastructure and have local access and distribution. So that's why we are launching this local stablecoins together with ramps into now reusing all that infrastructure that we built to serve the crypto native protocols and companies to have distribution and access to emerging markets. There is a difference in Carlos was saying equities are more liquid than bonds. In emerging markets, it's backwards. The bonds are more liquid than equities. And for example, in Argentina, the bond that we tokenize is the most liquid one, and it has the most volume, and it's higher than every other equity or company traded. Because also in emerging markets there is a lot of capital controls, and bonds are not only used for the bond per se, but also to do some types of transfers that are used through the bond market. So they have other uses that are not common in developed economies.
So interesting that you're going from tokenizing. We were going from tokenizing dollars to tokenizing local currencies, and I think. Do you think it shows is it a reflection of just at the level of adoption that there is in Latin America? Because if it's the local currency, then that's going to be used for payments and things like other than the traditional use case, which is access to dollars.
Yes, so we think we are in a level of, we believe that we're in a level of maturity that makes sense to start working on this. Most people think and do their lives thinking in the local currency, not in dollars. People that is going in emerging markets to buy USDC or USDT are doing it for savings, or because they get paid in abroad, because they're freelancers or are native to the crypto economy. But someone in Argentina or Brazil, they make their living in the local currency. They get paid in pesos or reals, and particularly in Brazil, most Brazilians don't know the exchange rate. So you could ask them for their life, and they will not be able to give you an exact number, or close to an exact number. And we think if we are going to get broader adoption of crypto native platforms and being able to offer DeFi for a larger percent of the population, we do need local currencies. It doesn't make sense for someone that makes their living in reals to go to Aave and borrow in dollars when they make their living in reals, because they will have a huge FX risk. And it will be much simpler in their mind to just borrow the local currency. And that these are things that we need in the infrastructure to be able to cross that bridge and like reach more people outside of the economy. That the crypto economy is growing and it's 4 trillion. It's still it is large, but if we want to get it larger, we also need these pieces of infrastructure to make it more useful to people.
I agree with that. As a European, I don't even know what's the exchange rate between euros and dollars. I'm surprised every time I come to Argentina, you take a taxi and they keep you telling you in the radio the exchange rate every day. It's like, who cares? Like, you live in Argentina, right? And when you understand the country, then you realize, well, but for most normal countries, you just think on your local currency. That said, you know, stable coins in other denominations have existed for years, at least in Europe, and they have almost zero market share. So somehow, that makes me think two things. One is that the actual local people are not the consumers of stablecoins today. They're just pure trading firms and pure, you know, crypto institutions that are trading, and therefore they're comfortable with dollars. And then second, that the consumption of stablecoins is not for actual payments today, maybe in the future, but it's basically for, as Seba said, for saving purposes. And then what you want to do is the opposite. The last thing you want if you're an emerging country is to keep your currency. You want to move it to another currency that is perceived as more stable. And if you look at Tether, their success and why they're much bigger than anybody else is because of their distribution of dollars in emerging markets that don't want to carry their own currency. So while it makes sense that ultimately you have stable coins in local currency, and that it's predicated on local people consuming those for either payments or for participating in the crypto economy, which I think is today, we're not there yet. So.
Yeah, adding a little bit to that, I don't think these assets that we are issuing of these local stablecoins will have demand per se. Like they won't have demand of people wanting to have pesos. This year is doing better than many other years, and maybe maybe Milei is able to create demand for pesos, but we think it's a piece that is needed to construct other use cases, and that will be the thing that creates demand for these assets and make them useful.
So fascinating. We saw here in this panel how crypto adoption is growing from the institutional side with Securitize, institutions coming to tokenize assets, and how Sebas from the more demand side, retail side of crypto, and how that's growing on in emerging markets in LATAM with things like local currency stablecoins. And yeah, we are at this super interesting intersection and just, you know, a turning point in the industry where, you know, things are becoming more serious. This industry is growing up. Like we're both here from many years ago, and you can feel the shift. Like at events, people ask me for my LinkedIn now and not my Telegram, which I don't know how I feel about that, but things are shifting, and I think, you know, it's important to finally bring this technology and make an actual change in the real world, and not just, you know, gambling and speculating, which, you know, can be fun, but I think, you know, this technology has the potential to make a much larger impact. And yeah, you guys are kind of at, like I said, at the forefront of making that happen. So thanks for the conversation.
Thank you.